Welcome to Salty Investors, episode number 28. Is it 29? I don't know. We've skipped a week, Tim. So we probably should apologize for that. We skipped a week. We left people in the lurch. There's people who've been out there biting their nails. They don't know what's happening. They don't know how to go about their lives because we just left them in limbo for a week. And we should also note that it's your fault because you decided to just take a trip somewhere.
Yep.
I mean,
Well,
do you even care about the audience, Tim? What do you got to say for yourself?
well, I go away for a few days and it looks like the recession's been cancelled. So I don't know what you've been doing over there, Scott. You should be
Oh,
looking after.
that was you, was it? Did you fix it?
All of a sudden, you go away for a few days and come back and it's all cancelled. So
Yeah,
show's
yeah,
back on. So yeah, all good.
absolutely.
Maybe we should
Well,
maybe be off more often. Get away more often, and you can
yeah,
change election. Everything. So,
fix everything, son. Yeah, well done. Well, might as well get into the salt because, yeah, I'll lead it off. So, the old saying, Tim, somebody wrote back, I don't know, 50 years ago or something, that Australia is a lucky country run by second-rate people who share its luck. And I just think that is an apt description of what's going on right now. We have a government that's pushing through a voice to Parliament, which really has absolutely no bearing on what's actually going on in the economy, the cost of living, pushing, 300,000 or 400,000 immigrants into the country. And our friend Phil, friend of the show, Phil Lowe, is now running around saying things like, oh, we might have to put rates up again because all these immigrants coming into the country are going to put pressure on housing, employment, and all these other things. So it is just a complete shit show. The voice to Parliament is just a distraction. Renewable energy is not living up to its promise, is more expensive, and we're shutting down coal. It's a complete shit show, and we are definitely run by second-rate people.
yeah, nothing new there. You only got to meet a couple of them, and you're like, wow. Like used car salesman. That's what the vibe you get when you
Yeah.
meet some of these people. So I don't
Yeah.
know. Just they're connected and they seem to say half smart stuff, but deep down I don't think they've got anything about value to add. It sort of leads a bit
No.
into my salt a little bit. So
Let's hear it.
well, might have heard Phil on the week in the week, just gone past that, a couple of new RBA board seats are up for grabs, and I had a
Yeah.
quick look at them and like, wow, these are two ACTU ex-hacks, and I thought the RBA was supposed to be independent, politically independent,
Yeah.
and you look up one and one's just a board seat warmer, doesn't add any value to society, and the other one's his fame is from the Fair Work Commission leading up that, and you're just like, wow, supposed to be independent here, people. I can't, we're just getting these hacks, and I just don't think these two are strong enough to fight inflation. But hopefully, I'm wrong. What do you think of that?
I don't know. It's just the sort of a revolving door of apparatchiks who get pushed out somewhere else, regardless of what they've ever accomplished anywhere else. Because if you've had a career in government, it doesn't mean you've actually achieved anything. You can, or a union, or there's no. That's why it's hard to say. I'm nominally for a meritocracy and best person for the job. When it comes to politics, it's not clear, and public service in general, it's not actually clear what that means. Is best person for the job in terms of politicians, does that mean someone who is good at getting elected but who has absolutely no policy ideas? I mean, what does it actually mean? Because at the end of the day, politics is about power, and what's good for getting power is not necessarily good for everybody else, right? And so what are these appointments to this board? Are they cosmetic? Are they to look like? I mean, is the Fair Work? Because the other scandal at the RBA now is that they haven't been paying people properly. Apparently, I don't know if you saw that. So they owe loads of back pay to a bunch of different people. Is it a cosmetic thing? Oh, let's get someone from the Fair Work Commission on. We won't have that again. I mean, I don't know. It's just
Well, there's supposedly another voice, to fight Phil instead of him, because he's got to go back to cutting rates for another 20 years. Surely, you've got to keep rates low here. That's the only way to keep the economy pumped. We don't want this guy He's just switched on us all of a sudden. We've got this guy's lifting rates on us.
Well, is that the argument? Is the argument that Phil's too hawkish and he's got to be reined in? Is that what it is? I mean,
I don't know, but it just
I mean,
sounds, we can't have this guy lifting rates on us. Everyone's got mortgages, and doesn't Phil know that? Is Phil an idiot? He doesn't know that I've got a mortgage, and I need cost of capital really low, basically around that zero bound mark, to keep the wheels turning here. I don't know. That's what it just feels like me, like they're just trying to. Phil's actually, got some balls for once, lifting rates a little bit. It's not even that high. You look at New Zealand, look at the US.
I know. I know. Yeah, well, speaking of that, let's move on to that, because I think that what you just said is very relevant. So this is the inflation report came out last week, didn't it? Because we weren't around last week. So inflation's down to about 5.5% year over year in the US. So that's good. Big drop. But core, which is what the Fed supposedly takes notice of, so we're just looking at the green bar there. So that's all items less food and energy. That's because food and energy, as you can see, they're very volatile. Energy was down 7, food was up 8. I don't know if I don't really care. But anyway, this is what the Fed supposedly is looking at. It's still 5.6%, I think, 5.6, 5.7 or something like that. And the change in core was really small. Actually didn't change much at all. On top of that, you had, which I don't have a graph of, but you had the employment report earlier in the month, which showed labour market's still strong. The labour market here is still strong. We had a labour report last week, and so you're looking at that and you're going, yeah. I mean, I guess you can fall back on the lagged effective monetary policy if you like, but it looks like there could be a few more rate rises. I'd definitely say in the US they'll go again. That's my view. And here, if Phil can find his testicles, we should probably go another one as well, I think.
Yeah, well, like that energy thing is all over the place. You look at oil, it's at $80 a barrel now. Like everyone's pricing in a recession there. Even OPEC, they're cutting production. They can't keep it up. So I think we're going to get a little bit of a relief there. But yeah, it's not looking good. What's going to happen? Like it gets to 3%. And then what do they think? Everybody, there's going to be cuts coming. Like surely they can't be cutting when it gets to 3%. It's got to get to that 2% bound range to think about cutting rates. You can't be cutting it at 3. Surely it's going to jump back up to 4 or 5. I
mean, it just depends where you are, I suppose. But I mean, where we are, if we get inflation down to 3, I mean, why would that seems about appropriate, doesn't it? If inflation gets down to 3, I guess it just depends on the velocity and where is it heading. But if it comes down in this perfect soft landing at a nice comfortable 3, which I sincerely doubt it will. Well, then you'd think you'd need an RBA rate at 3.5 at least, wouldn't you?
You're at least going to hold. If you're Phil and you're bored, you'd be going, well, it's working. We'll just stay here, and not risk it. Because as soon as they go, we're going to start cutting from here, which is what the market is anticipating here. Early next year. Look
at the housing. The housing market's already rallying. If you just look at house prices, it's already rallying just on they're on hold now. So, and we've got this quarter's we got the most mortgages resetting from fixed to variable happening. This quarter and next quarter, I think, are the worst. Okay. So I don't know. I have to put aside what I wish to be true and what is true. What I wish to be true is that people are kind of, to use a stock market analogy, buying the dip. They're buying the dip because they've been conditioned to think that it always goes up after the dip. But I don't know.
Well, we'll have to wait and see. But yeah, it's just a very interesting time. We'll have to get through this bit. I'll get the next couple of quarters, like you said, and the economy holds up. the soft landing's on. Like,
Yeah.
if people can get through those mortgage resets, the economy doesn't take too much of a hit. This would be the right terminal level for the RBA. They would have done a miracle job, and Phil,
Yeah.
Pulled it off here. Would be the savior of us all. So
Yeah.
still got to wait and
Oh,
see.
I think, yeah, no, Phil's in a tough spot. He's going to be hated. It doesn't matter what the outcome is.
Yeah. Phil's
and again,
got
it's just one of those things where, like, why do you expect that one guy can sort your life out? It's like the perennial problem. It's like, at what point do most people figure out that the government can't actually control your entire life, and you shouldn't want them to anyway, because they're pretty useless at most things.
Yep.
But moving on, this was Jesse Felder. He sends out some interesting stuff. Just again on the theme that we sort of touched on 2 weeks ago, is that the fallout from the mini banking crisis, it is going to have an effect. So you can see these. They had smaller US-based commercial banks. So this is not your JP Morgans, obviously, but they had a buffer of 700 billion in cash to sell if depositors want their money back. That buffer is gone. So there's been a flight to the bigger banks, and this has got to have some pullback. The thing I didn't include here as well, which is increasingly sort of, I think people like Jim Chanos have been talking about for a while, is commercial real estate. Commercial real estate hasn't really come back, and it's part of the people working from home idea, and the rents and the yields on commercial real estate in the United States are pretty ordinary, and it's going to have to be some write downs on.
Yep.
Yeah,
those REITs are in trouble. Those REITs are in trouble for sure. Like, everyone who bought those dips in COVID, they've done it right now, but
yeah,
I'd be trimming some of that stuff. Wow, that's got
Yeah.
headwinds. Like, why would you, offices aren't going to increase in size, or, and outsourcing and AI and everything else that's coming on. Like, wow, you'd be a bit worried about that, but I don't know.
Yeah. So, yeah, I think that's sort of, it's just another headwind. But maybe, Tim, this is how you engineer a soft landing, just by pure luck. You have the economy still bowling along, but you have a little bit tighter credit.
Yep.
And somehow it just works out perfectly. Somehow I doubt it, but who knows? Possibly. Given my luck, it probably will work out that way.
Yeah, I think someone's looked back, and it's happened once before. Like,
right.
These huge rate increases, and they pulled it off once before, so it can happen again.
Right.
A couple of things go in their favor, and but odds on, I'm a bit worried, but wait and see.
Yep. So that's pretty much it for the macro stuff this week. What do you got here, Tim? Is this your list of?
I'm thinking of doing a 5-stock portfolio, and I thought, boy, that's a bit concentrated. So I thought, I've got to open this up a little bit and broaden the horizon a little bit. So I'm thinking of a 10-stock portfolio, but I like to bring hard things to you, Scott. Don't bring the easy balls to you, mate. So this is one where you got to look out 10 years, 10-year look out, and you got to pick stuff that's still growing. This is the hard, so it's got to be super high quality. It can't be, software. You can't pick some of these little software names that we like, because you're like, look at 10 years. Can you sort of guarantee me that these guys are going to be around, or they're going to get,
nope.
I know. Yeah. So you be honest with yourself here, So it's turning us from, the 3-year to 5-year trader into a 10-year trader. Could you possibly do it? And then you sort of can't pick two in a sector. So people cheat here. Some of these big funds, they do like MasterCard and Visa.
And Visa,
Yeah, and S&P 500 and Moody's. You sort of got, but then you got half your portfolio stuck with a couple of sectors here, and you get some regulation change within that 10 years. You're going to get, drawdowns at 20%, 30%. So you've got to be tougher on yourself and actually pick a winner out of those, oligopolies. You got to. That's how hard it is here. So
Yeah, maybe the exception there is that I would have thought that if the duopoly on ratings agencies was going to go away, it should have happened in '08
yeah,
when
yeah,
they
yeah.
committed outright fraud, and they're still running the show.
Well,
Uh,
well,
uh,
Moody's didn't get on my list, not because I don't think it's a bad company. It's just morally, I'm just a little bit, and I think S&P is a little bit cleaner.
hmm,
Even though they're not clean, obviously they're
yeah.
into some pretty dodgy stuff as well. But out of the
But what
two,
about Mastercard and Visa? Did you just flip a coin, or
no,
you just
just
think,
better return on
yeah,
Mastercard. But yeah, if you break them down properly, they're very similar. But again, you're seeing Apple at the moment. Apple's coming out with an interest, 4.5% or whatever it is, interest
yeah,
rate on you.
hmm,
And why wouldn't they have a wallet, like a PayPal type wallet, and possibly do some credit type stuff?
yeah,
They could eat into Mastercard and Visa here. So I don't know. Yeah, and you see some big names. Like I've only got two fangs on here. I've only got Amazon and Microsoft. Well, Microsoft's not really a fang, but
yeah,
but if you didn't have them in the last decade, you're toast. Like there's
mm,
no way that you could outcompete the S&P 500. So, but I'm just worried about Facebook, Netflix, those sort of companies. When you look at 10 years, like how certain are you that they're going to be around? So, but Microsoft
yeah.
and Amazon are the ones that I thought, you know, um,
Yeah,
and
Microsoft's a no-brainer for me, but
okay.
the same with Nvidia. Like the cycle, like I don't know how they're going to negotiate this whole new technology cycle with AI and everything else. I mean, you know, theoretically they should be able to capitalize on it, but
Yep.
I don't know.
Yeah, if cloud something comes in and then, you don't really need GPUs too much. I don't know.
Yeah,
And they haven't got that long of a history. That's the other thing as well. And it's still semis. Semis are cyclical. This
yeah,
is what I'm trying
yeah,
to avoid
that's
here.
right.
I'm trying to avoid, be stuck in a company for 5 years that's on a down
But you do have
cycle.
a Estee Lauder is the retailer.
Yes, but in recessions, it sort of does
Mm,
hold up pretty good.
yeah,
And you can switch some of these out. Do you go L'Oreal, instead of Estee Lauder, and Nestle, should I be doing Pepsi or another
mm,
consumer staple here? Putting that name in. I put a couple of cyclicals in here. NVR housing and
yeah,
Copilot, which cars. And the car one, you might think, oh, you've got electric cars coming. We won't be having accidents. But that's more than a decade away. There's no way that within a decade we could all have self-driving cars because they only get replaced at, you know, 3 to 5% per year. So
yeah.
you're looking out. That's
Well, the
assuming.
risk there is government making everybody buy
Yes.
one of these wonderfully affordable EVs that cost you $10,000 for a power wall and $70,000 for the car. Yeah, not a problem. We'll subsidise it. Okay, how are you
Yeah.
going to do that?
Yeah. So this is what I've come up with currently. Obviously, I've got to put more work into it. I'm trying to find stuff that's got low debt as well. The holy
Yeah,
trinity of low debt, huge growth, and capital allocating. Great here. So I still haven't totally locked these down, but this is what I've come up with, and I think could I hold these for 10 years and just
yeah,
coffee can them, and just run it as a fund, and let it ride, basically. Um,
yeah. I think I could be pretty confident with holding 7, maybe 8 of those. I think. Yeah, it's the NVR and the Copart that just because of the cyclical nature of it. I mean, Estee Lauder's and Nestle are open to, but I mean Nestle not really. I mean, do people really?
uh,
Uh, you know,
it's more of a
probably more.
defensive play there, Nestle, because it doesn't
Yeah,
actually grow that much. Like,
no,
so, but yeah. So yeah. that NVR and are sort of cyclicals, but you look at their returns, it doesn't look like cyclicals, like it, because they just like power through, GFCs and things like that. 2018, just power through them. You can't even see it. So do they?
So what are you going to stick with 10? Are you want to cut it to 5, or what? Or you don't care?
I'm trying to. What's my sell discipline going to be? This is what the problem I came back with 5. Like, if one of these runs away, like an NVR Copart, from 10%, I'm thinking of maybe trimming at 25, back to 20 each time. And then it's better if I start with 20, do you wait till they run to 40% and hopefully you catch that and then trim, or you just don't worry about it, or what have you got any thoughts on that? Or?
Oh, well, I mean, the first thing to do is, why is it running? Is there a reason for it or not? Did they make an acquisition? Is it, has the story changed, basically? Because if the story has changed in some meaningful way positively, then I would let it run, or not trim as much as your discipline. Have a fallback discipline, because things are going to change. I mean, I don't know, Microsoft comes out and says we've incorporated AI into this now, and we don't have any help desks anymore because we don't need one. We just cut 15% of our staff costs overnight. Well, maybe it is worth more than let it run.
Yeah. So I want to leave enough room for them to run. That was the problem with having such a concentrated, going from 20%. You're like, oh, do you let that run to 60? And then, because you see this happen all the time, when people don't, have some discipline in the sell side here a little bit. Like, I love letting things run. Like, I've got no problem at all. But, if you could reinvest a couple of, one runs a lot and you reinvested that in some of these others, like, wow, that could really compound over time. But yeah, I don't know. So that's what I'm coming up with at the moment, trying to push myself here, to make my life hard. So if you have any ideas, let me know, or anybody else does. Come up,
send them in.
Yep.
All right. Let's get on to who we got here, Tim. Who's this Auto Trader Group?
So it's like car sales of the UK. So basically, this is the biggest marketplace for selling cars in the UK. And UK is still on a fire sale at the moment. Like, they're still, 10% inflation you might have saw. Like, the place is burning down over there. Like, so, but you just look at this company, you look at the shares outstanding, they've taken it down from $1 billion in 2015 to now, they've got 920 something million shares. And you just look at some of these numbers, like, it's cheap now, like, it's about what you should be buying it at. The price to free cash flow, 22, and you just look at the return on invested capital in the 40s. Like, and gross margins 70s. How much are they actually?
Operating margin
60. Like, this is just insane. And you look at dividend, they're only paying out 32% of that. So even if you cut that return on invested capital by 70%, like, it's still a huge number. Like, that is interest coverage 100 plus. Like, some from, depending how you measure it, but like, these are just insane metrics. But people who should be buying it, like Terry Smith, like, why isn't the brother buying it? I think he's got currency risk or something. You think he's a bit worried about here? He's just done so well over the last few decades. But but just look at that debt, negative, 41 billion. And then pulling in 260 a year, like, and just look at the growth in it. Like, you compare it to 17, 18, 19, it's just, COVID hasn't slowed this thing down at all. Like, it's slowed down in COVID actually, but it's just powered ahead compared to 2019, that free cash flow.
So 2020, it did take a dip. Free cash flow did. Yeah.
But that makes, that's because of COVID. No one needs the car, everyone's at home.
Yeah.
So it makes total sense. And you couldn't even buy cars, and the prices we're just out of this. And you think in a recession, maybe this would do well because everyone's got a second car or whatever. They might want to sell it off. So it might be more resistant than you think, but boy, this is going to get hammered. Like it's going to.
Did you have a look what it did? Was it around in 2008?
No, it wasn't around then.
Yeah,
but yeah, you have to go back and look at something like, I don't know if car sales was or something like that to get an idea, but I think this is going to get slaughtered. Like people are going to go after this pretty hard. They're going to see it as discretionary. You know, this is one that they're going to throw out, I think. And yeah, just another interesting one that I'm seeing at the moment.
Well, what's the split between how much do they make off insurance and compared to like just selling?
I'm not sure of the actual split there, but
they sell insurance.
Yeah, which is a nice business to have. You know, you're thinking you're selling a second-hand car on the private market, you can bundle that in as an extra service. You know, no wonder the returns on capital are, you know, are off the charts here. You know, and you think you could bundle that to go to some insurer and say, hey, you know, give us a deal here, and they're not actually underwriting it all. I'm pretty sure they wouldn't be underwriting it. They wouldn't be smart enough to do that, surely. You'd think, but surely they're offloading all that and just taking a commission. Hopefully, I haven't looked at that, but
yeah. All right. Well, that's a good find. Add that to the list, ladies and gentlemen. You heard it here first, courtesy of Tim. Anything else to add this week, Tim?
No,
all good. All right. Thanks for listening, everybody. We will catch you next time.